Welcome to Tikona Capital FinServe's Market Outlook for May 2025. I'm excited to share our comprehensive analysis of current market trends, opportunities, and strategic insights that will help you navigate today's dynamic investment landscape. At Tikona Capital FinServe Private Limited, your investing co-pilot, we provide comprehensive wealth solutions for working professionals, HNI clients, and family offices. Our services include equity model portfolios, mutual fund solutions, differentiated PMS offerings, unique AIFs, unlisted equities, startup investments, and IPO advisory services. Our philosophy centers on creating finite solutions in an environment of infinite financial possibilities. Important disclosure: investments in securities are subject to market risks. Please read all documents carefully before investing. This presentation should not be considered as investment advice. Please consult your financial advisor before making investment decisions. Past performance does not guarantee future results. For information and detailed disclosures, visit our website at tikonacapital.com. Our May outlook highlights the challenges of slowing world trade, escalating US-China tensions, and the balancing act between global risks and India's domestic resilience. We'll explore global growth signals, central bank actions, commodity trends, equity flows, and how strategic positioning can help navigate volatility. Global economic momentum is clearly slowing. Growth downgrades from global agencies highlight weakening trade, tightening financial conditions, and cautious business sentiment. The United States and Europe remain under pressure, while China struggles with its property sector. In contrast, India continues to demonstrate resilience, driven by strong domestic demand. Global GDP forecasts were revised downward in April. The world economy is now expected to grow at 2.8%, compared to earlier projections of 3.3%. Advanced economies are slowing to 1.4%, while emerging markets are at 4%. The United States slipped to 1.8%, while the Eurozone fell to below 1%. China faces weakness at 4% due to property and export stress. India remains the standout with 6.2% growth, supported by consumption and services. Latin America fell to 2% on commodity price shocks. India continues to lead as the fastest growing large economy. Central banks remain on different paths. The Reserve Bank of India has eased policy to support growth, while the United States Federal Reserve has stayed cautious. Divergent policies are influencing capital flows, with some money moving back into emerging markets. Investors must remain watchful as monetary signals diverge across economies. United States equities and the dollar both weakened during April. After a strong run between October and January, the Dow Jones Industrial Average corrected alongside the US dollar index. By late April, both indicators were at multi-month lows. This reflects investor caution as earnings growth slows, trade tensions persist, and capital flows shift toward emerging markets. The parallel decline highlights the strain on US assets in the current macro environment. The United States and China remain locked in a prolonged tariff conflict. Bilateral trade flows have collapsed, pressuring global supply chains. American corporates are reporting weaker revenues and earnings expectations have fallen to multi-year lows. This trade war continues to be a major risk to global financial stability. The prolonged tariff battle is hurting the American economy. Import costs are climbing, exports to China are slowing, and business confidence is deteriorating. Inflationary pressures are rising while investment has weakened, signaling continued challenges for growth through the remainder of the year. The trade war has created an unusual challenge for the United States economy. Import costs are rising, supply chains are disrupted, and business confidence is falling. This has increased the risk of stagflation, where high inflation coincides with low growth and falling markets. In contrast, a Goldilocks scenario with low inflation and moderate growth feels increasingly unlikely. The combination of tariffs, weaker exports, and slowing investment suggests that the US economy may remain trapped between recessionary pressures and inflation risks, making the outlook more uncertain than before. In April, Beijing rolled out a sweeping economic stimulus package. The People's Bank of China cut reserve requirements, injected 1 trillion yuan in liquidity, and lowered repo rates. Lending was directed toward households, technology, artificial intelligence, and renewables. IPO approvals were paused to stabilize markets. While this may calm near-term concerns, the question remains whether it marks a true turning point or just temporary relief. India continues to be a bright spot in the global economy. GDP growth for fiscal year 25 is projected between 6.2 and 6.5% by agencies like the IMF and RBI. Inflation cooled to 3.2% in April, the lowest in 6 years. While exports remain soft, robust domestic demand is anchoring the economy. The Reserve Bank of India has taken decisive supportive action, initiating monetary easing with a 25 basis point rate cut in April and shifting to an accommodative stance. This move, aimed at boosting growth, is backed by a significant injection of over 6 lakh crore rupees in liquidity and comes as inflation remains firmly within the target range, providing room for further supportive measures if needed. April 2025 was a positive month for India's debt market. 10-year G-Sec yields dropped sharply to a 3-year low of 6.33%, corporate bond yields fell, and credit spreads narrowed. The system liquidity swung to a surplus, supported by RBI's actions, creating a conducive environment for borrowing despite some foreign investor outflows. Commodity markets presented a mixed picture. Gold prices hit a record high, driven by safe haven demand, while Brent crude oil prices slid significantly due to OPEC Jor output boosts and trimmed demand forecasts. The Indian rupee remained stable, trading in a range and closing stronger, powerfully supported by record foreign exchange reserves which continue to climb towards their all-time high. Despite a weak start to the month, both the Nifty index and the Indian rupee demonstrated remarkable resilience and recovered strongly. This recovery underscores the underlying strength of the Indian market and its ability to absorb global volatility, supported by robust domestic fundamentals. Now let's look at equity market outlook. A clear divergence in investor behavior is evident. Foreign institutional investors have been consistent net sellers throughout April and May, applying downward pressure. However, this has been decisively offset by steady positive inflows from domestic institutional investors and mutual funds, which have provided crucial stability and support to the market. Market performance in April showed clear leaders. Bank Nifty and small-cap indices led short-term gains. Over a 3-year period, CPSE and realty sectors were top performers. Globally, Germany's DAX and Chinese indices like HSCEI led the pack with strong 1-year returns, while in India, growth-oriented sectoral indices and alpha strategies outperformed. Large-cap equity funds outperformed their broader category peers in April. Thematically, international equity funds were the standout performers versus other strategies. Within debt, credit risk funds delivered strong returns, but the month's best-performing asset class was unequivocally gold, highlighting its role as a safe haven. Market activity in April highlighted a tale of two investors. Foreign institutional investors were net sellers, while domestic institutional investors continued their strong buying spree. IPO activity saw a moderation in oversubscription levels compared to the frenzied peaks of recent months, indicating a normalization of market sentiment. India's IPO market in April 2025 remained exceptionally robust. 12 offerings saw an impressive average subscription of 95.8 times, demonstrating unwavering investor appetite for new listings and confidence in the primary market's ability to generate wealth. Let's have a look at the investment strategy and future outlook. The geopolitical situation between India and Pakistan has introduced a significant layer of uncertainty. Historical analysis shows that such conflicts have typically led to slower economic growth, higher prices, and larger government deficits, making it a critical factor for investors to monitor. Historical market reactions to war and major geopolitical events are characterized by initial sharp volatility and sell-offs, often followed by recoveries once the initial shock is absorbed. The key for investors is to avoid panic and focus on long-term fundamentals rather than short-term headlines. From a valuation perspective, the Nifty is trading near its long-term average following the correction since September 2024. This suggests a more reasonable entry point for large-cap investors compared to the elevated premiums seen in the broader small and mid-cap segments. A deep dive into small and mid-cap stocks reveals a challenging picture. Margin expansion has not kept pace with the significant re-rating in valuations these segments have experienced. This divergence suggests that future returns will be heavily dependent on earnings delivery rather than further valuation expansion. The India Volatility Index, or VIX, has been rising, reflecting increased investor anxiety and expectations of near-term market turbulence. This rise is primarily driven by escalating geopolitical risks and serves as a reminder for investors to ensure their portfolios are structured appropriately for potential volatility. To summarize India's macro picture, we remain the world's fastest-growing major economy with moderating inflation. The government maintains a strong infrastructure focus, and the RBI has shifted to an accommodative stance after a rate cut, with system liquidity turning into a surplus. These factors create a supportive domestic backdrop. In equities, Bank Nifty, small caps, and SME IPOs led gains. While FIIs were sellers, domestic MFS and Ds provided strong support. IPO activity remains robust, though oversubscription is moderating, and overall Nifty valuations are now near long-term averages, presenting a balanced opportunity. Globally, growth is slowing, and US-China trade tensions have escalated, collapsing trade flows and dampening earnings. China has responded with a major stimulus package. Meanwhile, oil prices have dropped sharply, gold hit record highs, and overall commodity prices have softened, reflecting concerns about global demand. India's long-term wealth creation story is underpinned by powerful multi-decadal themes: globalization through manufacturing and China Plus One, rising consumerism, the formalization of the economy, the clean energy transition, the financialization of savings, and the ongoing technology boom. These themes offer scalable, long-term opportunities for investors. Key risks include rising volatility, geopolitical tensions, overvaluation in segments, and technology disruption. The mitigation strategy is to maintain diversified portfolios aligned with risk tolerance, avoid going severely underweight due to event-driven risks, and consider allocations to alternate asset classes like unlisted equities and pre-IPO opportunities for diversification. At Tikona Capital Finserv Private Limited, we believe in creating finite solutions in infinite possibilities. Our triangle logo represents filtering out unknowable edges from the ultimate circle of market uncertainty. Founded and led by Sumit Poddar, our team is committed to empowering customers to invest in high-quality businesses and build long-term wealth. Connect with us at tikonacapital.com, follow us on LinkedIn, YouTube, and Twitter. Thank you for watching, and remember, invest with conviction, build long-term wealth.